Hi guys, good afternoon again. This is your Prof. Zeus, and I'd like to welcome you to another session with me on intermediate accounting. And for this session, oh by the way, before we go any further, I'd like to invite you to please subscribe to my YouTube channel, and if you can, also share this to your friends and classmates who might be needing some guidance on, in their studies of intermediate accounting. Okay. Now I will be answering some questions from this book that we are using, the 2019 edition of Intermediate Accounting Series Volume 1. This is based on IFRS, okay, including those that are effective 2019, and this is by, the authors are Anita Robles and of course Dr. Patricia Empleo. She's my college professor actually. Okay, let's since we're discussing about notes and bonds, okay, let's have some problems on notes and bonds. So let's answer MC26. So MC26 is a problem about notes payable, a non-interest bearing note payable with a face value of 3 million. Okay, so here 3 million for a piece of land. Okay, for a piece of land purchased from Jardine Corporation. The note is payable in annual installments of 1 million every December 31, starting on December 31, 2019. The land has an equivalent cash price of 2.4 million, a price that provides a note an effective interest rate of 12%. Okay, now with regard to the initial recognition of the land, we know that from our discussion on acquisitions of fixed asset or property and equipment, number one is of course the cash price equivalent. So if the cash price equivalent is given, then we will use that to value the property that we have acquired. Now, if that is not given, then we will use the present value of the future payments. Now, in this case, since it is already given, the equivalent cash price is 2.4. So, valuation of the land is 2.4 million. Okay? So, therefore, what will be our entry for this problem? So, the entry upon initial recognition in the books. Okay? So, therefore, we will debit land for the 2.4 million. And then credit bonds payable, notes payable for 3 million pesos, and of course the 600,000 would be the discount. So this is our entry on initial recognition of the land and of course the obligation in the books. Okay, so when you prepare the financial statements as of the date of acquisition, among your non-current assets you will have land. You will show land at 2,400,000, and of course among your non-current your liabilities, okay, among your liabilities we will show portion that is current. Why? Because there's one, the principal is payable every December 31st, right? So there's a 1 million current, and then of course among the non-current, so you have bonds payable, non-current, again bonds payable, and this is for 2 million. Okay. Okay, but we have to discount the 600,000. We have to distribute between the current and the non-current. We'll do that later on. But this is how it will be presented in the financial statements at the date of acquisition. Okay, let us now prepare the amortization table. So we have here the date. We have the principal payments, or payments made to principal. We have the interest, and then we have the carrying value of the obligation. Okay, so on January 1, 2019, that is the date of transaction. So we have here the 2.4 million as the carrying value of the obligation, right? Okay, on December 31, 2019, we will have to pay 1 million pesos. And so therefore, how much now will be the interest? Remember, during the year 2019, the whole 2.4 million was outstanding. So this will be subjected to interest, the entire amount of 2.4 times 0.12. So So that would be 288,000. Okay, so remember, this should be equal to 3 million, right? But because of this 1 million, this would be equal to 0. So therefore, our carrying value is equal to the 2.4 million minus the 1 million payment plus the amortization of the discount. So this is 1,688,000. Okay, and then continuing 31, 2020. So therefore another 1 million. And so therefore times 0.12. So this is 202,560. So therefore 1688 minus 1 million plus 202,560. So this is 890,560. And then 12/31, 2021. Okay, we have another 1 million here. Okay, times 0.12. So this is 106,867. Actually, this might not be the answer because we have to balance this one, diba? So this should be equal to 0. So therefore, how much should that be? That should be 1 million minus 890,560. So this should be 109,440. So this is 0. Okay. So therefore, you have here the amortization table. So going back to our presentation, so we can already deduct the discount pertaining to the current portion, which is the 288,000. And then the other two would be for the non-current. It's 202,560 plus 109,440. So therefore, that is 312. So less 312,000. So less 2 million. Okay, so this is 1688. Then the other one is 1 million minus 288,000. So this is 712. Now, why did we do that? Now, if you look at the timeline, okay, you have to pay 1 million every year. 1 million. This is 1 million, and this is 1 million. Now remember, whatever we have to pay within 12 months from balance sheet date will have to be considered current. Now, since we are preparing the financial statements as of the date of transaction, what is 1 year from January 1? It's going to be January 1 of last year, of the following year. And this will be paid December 31, right? So therefore, this is considered as current as far as January 31, 2019 financial report is concerned. And this one will be considered as non-current, okay? But when we prepare the December 31, 2019 financial report is concerned, this is already paid. So what is left is 2 million, and this will be considered current, and this will be considered as non-current. Okay, so that's how we will present that in the financial statements. Okay, so therefore, to answer this one, so how much is the interest expense? The answer is letter B. That is 288,000. And then next question is, use the same information. How much of the notes payable net of discount should be reported as part of current liabilities on December 31, 2019? So again, December 31, 2019, this is already paid. So what is left is this one and this one. So this will be considered current, okay, because this is payable. This will be paid within 12 months, and this will be considered as non-current. So therefore, if you prepare the financial statements as of December 31, 2019, you will have among your current liabilities okay, you have bonds payable for how much? That's 1 million pesos less your discount on bonds payable for how much? That's going to be 202,560. So therefore, that's 1 million less 202,560. That's 7. So the current portion is 797,440. While the non-current so you have bonds payable. Sorry. So for the non-current portion, you have bonds payable of how much? 1 million pesos. And then of course less the discount. Bonds payable of 109,440. So therefore 1 million minus 109,440. So this will be 890,560. 890,560. So December 31, 2019, you will show your current liabilities, bonds payable of 1 million, less your discount on bonds payable of 202,000. And of course, non-current portion is 1 million, the remaining, less the discount on bonds payable of 109,000. Okay, so to answer the questions here, how much is the current portion? So current portion is 797,440, so that's going to be letter D. What is the balance of discount on notes payable? So what is the balance of discount on notes payable as of December 31, 2019? So therefore, December 31, 2019, the balance of the discount. So that's going to be this two, right? 202,560 plus 109,440. So that would be 312,000. 312,000 is letter B. Okay, so that is letter B. Okay, let's go now to the next one. Okay, so this is bonds. On January 1, 2019, Alabama Inc. issued 10-year bonds with a face amount of 1 million and a stated interest at 8% annually on January 1. The bonds were priced to yield 10%. Okay, the rest of the value factors. Okay, so let's have this one. Let me see. More comfortable writing this one. Okay, so that is MC30. So multiple choice 30. Okay, so it's a 9-year bond and 9-year, 10-year, it's an 8% 10-year bond that yields 10%. Okay, so face amount of 1 million and okay. So if you're going to look at the timeline, so this is 10-year bond. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, so at the end of the 10th year, the 1 million will have to be paid. Okay, but in between you have to pay the interest. Interest is 8%. So 1 million times 0.08, that's going to be 80,000. So every year, the company will have to pay 80,000. Okay, so if you would see in our timeline, okay, again we have this fairly stable or uniform cash of 80,000 and then the 1 million. So for the 80,000, we will be using the present value of annuity factor. But for this one, we'll be using the present value of 1. So let us compute for the present value because the question is the issue price. So present value of our principal, which is 1 million, and then present value of the interest, which is 80,000. Okay, so this is for 10 years. That's at 12%, 10%, 1.1. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So on the 10th year, this will be 0.3855 minus 1 divided by 0.10. Okay, so this would be 6.1445. Okay, so therefore 1 million times 0.3855, so that's 385,500, and then 80,000 times 6.1445, so that's 491,560 plus 385,500, so this is 877,060. That is the issue price of the bond. Okay, so actually the factors are already given here, but for the purpose of discussion and illustrating how it is computed, we use the ordinary calculator. So here we will use the present value of 1 for 10 periods, okay, at 10%. Because discounting is using the effective interest rate. Don't use the nominal. You use that to compute for the nominal interest. So essentially, we will disregard this, and this will be the factors that we will use, okay? So if you would look at the choices, so the nearest is letter D. But if we will use this, we will get this one, okay? Okay. Okay, let's have MC31. So the answer is letter D. MC31. Okay, the following information pertains to San Francisco Company's issuance of bonds on July 1, 2019. So face amount is 10 million, term is 10 years, stated interest is 8, then purchase payment dates is July and January. So what does it mean? It pays interest semi-annually, and the effective is 12. Okay, what did I say earlier when we discussed about semi-annual payments of interest? We're going to divide the rate, okay, by 2. So this will be 4 and this will be 6, and then we will multiply this by 2. So that's going to be 20. So using this present value, this is one trick that the examiners might give you, okay, this information on different factors, okay. So you have to be very careful in choosing which factor you're going to use, okay. So as I mentioned, this will be for 20 periods. So we will now eliminate those that are 10. So this is 20, 20, 20, 20. So we are now down with 4 choices, okay. Now remember, for the present value of the principal, since this is one-time payment, so we will use the single amount, okay. So single amount, so this would be single amount, or this one, single amount. So we'll look for the single amount. So this is single amount, single amount. So single amount, and then this one is single. Alright, so you have there the single amounts, and then of course, so we're down to the when we have 2, no? And then the other one is what? The interest. So interest is, since it's an annuity for 10 years, right? So annuity, so ano tayo? 4 and 6 actually. Ito pala tayo, 4 and 6. Okay, so therefore annuity for 20 periods. Okay, so therefore we are going to use the single amount, which is that's 6%, this one, and then we are going to use the ordinary annuity for 1 for 20 periods, this one. Okay, so let us solve. So therefore, the question is the issue price, present value of the principal. So principal is 10 million multiplied by, okay, the single amount for 20 periods is 0.31, and then present value of interest is how much? Okay, so that's 10 million times stated interest is 0.04, so it's going to be 400,000 multiplied by annuity. So annuity for 20 periods at 6%, so this is 11.47. So therefore 10 million pesos times 0.31, so this is 3,100,000, and then 400,000 times 11.47, so this is 4,588,000, so plus 3,100,000, so this is 7,688,000. So this is the issue price of the bond, okay. Okay, so the question is each 1,000 bond. So therefore the answer is letter B, 768.8. Okay. Well, we will have to discuss this first. Let's look at other problems. Okay, let's solve this. MC40. So MC40, on July 1, 2019, Madison Company received 1,038,880 for 1 million face amount. So therefore, he received more, right? So therefore, it seems that there's a premium. Okay, face amount 12% bond, 12% bond, a price that yields 10%. 12% and 10%. So what is this 12%? The 12% here is the nominal. So this is the nominal and this is the effective. So if you would see, the nominal is more than the effective. That's why there is a premium, because the debtor is paying more than the others. Okay? So the question is, how much is interest expense for the 6 months ended December 31, 2019? Okay, so ang sabi natin, if we are asked to compute for the interest expense, the shortcut would be the carrying value of the obligation multiplied by the effective. So therefore, how much is the carrying amount of the obligation? That's 1,032,880 multiplied by the effective interest of 10%. Okay? So that would be 1,032,880 times 10%. So that's 103,288. And since this is July, times 1/2 divided by 2, that's 51,644. That is 51,644. So the answer is letter C. Using the same information given in MC40, what should Madison report on bond liability on December 31? So therefore, 41, bond liability, so you have bonds payable. For how much? The face amount of the bond, which is 1 million. Now, it still has a premium, right? So therefore, the premium is 32,880, right? 32,880, but then there's already an amortization of 51,000. Sorry. It's fine for the nominal. Nominal is how much? Interest expense is this one, 651. But the nominal is 1 million minus, times 0.12. So 120 divided by 2, 60. So therefore, the difference is your amortization, 644. That's 8,356. Okay? So this is 8,356. So therefore, the difference is 32,880 minus 8,356 is 24,524. So this is now the value of the discount, the premium. So therefore, the remaining premium on bonds payable is 24,524. So therefore, that's 1,024,524. So the answer is, okay, letter A. Okay, let's go to MC42. Okay, issued its 9%, 2 million bonds, which matured January 1, 2026. The bonds were issued for 1,878,000. So we can see clearly that this was issued less than the face amount, so therefore there's a discount. Okay, and why is that? Because the nominal interest is lower than the effective interest. So people would be going for a higher interest. So for the bond issuer to get the attention of the bond investors, he will have to sell this at a lower amount. Okay, bond discount. So the question is, what's the carrying value of the bond on December 31, 2019? Okay, so December 31, 2019. So what are we going to do? So we have the bonds payable of 2 million, right? And then there is the issue price is 1,878, resulting to a premium, to a discount of 122. So we're going to amortize the discount. Okay, so the carrying value of the obligation is, so January 1, carrying value of the obligation is 1,878. Okay, and then December 31. Okay, so we have 1,878. The effective is 0.10. So that's 187,800. 187,800. And then the nominal is 9 times 2 million. So this is 2 million times 0.09, that's 180,000. So therefore, the difference is 7,800, right? Remember, we have to increase this to 2 million. So therefore, we have to add the 187,800. The 78 we have to add it back, no? Plus 1878. So this is 1,885,800. Okay. So therefore, the answer is letter A. Okay, let's have MC44. Okay, MC44. So Nevada issued 5 million 10% 10-year bonds on July 1. Okay, and then for 113.6, when effective interest rate was 8%. Interest is payable on June 30 and December 31. So we're asked to compute for the interest expense that should Nevada report in the profit or loss for the year ended December 31, 2019. Now remember, the issue date is July. That's one thing. So we are going to find for the interest only for half year. No. Now this is another way of expressing the issue price of the bond. Okay, this is 113. What does 113 means? That means the bonds were issued at 113.6% above the face amount. So meaning there's a premium. Okay, there's a premium on the bonds. Okay, let us compute. So therefore, the bond is how much? 5 million. So issue price that is 5 million multiplied by 113.6%. So that's 5 million times 113.6%. So this is 5,680,000. So this is the carrying value of the obligation. So less than 5 million, you would see that there's a 680,000, and this is what we call the premium. So the question is, how much is the interest expense? As I mentioned, interest expense will be simply the carrying value multiplied by the effective interest rate. So carrying value is 5680 multiplied by the effective interest rate of, now remember, they're paying 2, semi-annual, so you have to divide the interest. So therefore, the effective is 0.08 divided by 2, that's 0.04 times 5680. So therefore, this is 0.04%. So this is 227,200. So this is now your interest expense, which is 227,200. Letter C. MC 45. Okay. So Fresh Company has outstanding 7% 10-year 2 million face value bonds. The bond was usually sold to yield 6% annual interest. On June 30, 2018, the carrying amount of the outstanding bond was 2.1. What amount of unamortized premium the on bond should Fresh report on its June 30, 2019 statement of financial position? Okay. Okay, so you could see that there is what? A premium. There's a premium because the effective interest is lower than the nominal. So the issuer of the bond can request for a higher price. That's why it's 2.1 million. Okay. So I think this is easy for you, no? This bit is in a man, so you can take care of this one. So I think that's about it. Those are some sample exercises that we can solve from the book that we're using. Okay, I'll see you again for the next session on financial accounting. Okay, thank you very much, guys, and bye-bye.